picture this. You are sitting at your kitchen table with your bank statement in front of you. You have been doing this every month for 40 years. You look at each transaction, confirm everything checks out, and put the statement away. You are organized, you pay your taxes, you have never bounced a check or missed a bill in your life. And right now, without your knowledge, a federal algorithm may be building a case file on your account. Not because of anything you did wrong, not because of any crime, because of a pattern, a habit. Something that made perfect financial sense 10 years ago, and now, under rules that were changed without any announcement to you, looks to an automated system like exactly what a money launderer does. 3 specific rules are now quietly governing every checking account in this country. Most retirees have never heard of any of them. And the cruelest part is this. The instincts you spent a lifetime developing around money, the careful, conservative instincts, are the exact instincts most likely to set off the systems watching you. Before we are done today, I want to show you the most common mistake that retirees and people approaching retirement are making right now. Millions of people. And I am going to give you one technique you can start using today. It costs nothing. It takes 30 seconds. That could be the difference between a clean record and a federal notice that takes 6 months and sometimes thousands of dollars in professional fees to fight your way out of. Stay with me for the full picture. The last rule is where the most penalty notices actually land. Let us start with the rule everyone thinks they understand, because the misunderstanding is exactly what makes it dangerous. The $10,000 rule. You have heard about it your whole adult life. Deposit more than $10,000 in cash and your bank is legally required to file a currency transaction report, a CTR, with the federal government. That is still true. The Bank Secrecy Act, signed into law by Congress in 1970, requires it. That threshold has not changed. What has changed is everything around it. Banks are now required to file a second, separate type of federal report called a Suspicious Activity Report, a SAR, for transactions as low as $5,000. The legal standard comes directly from FinCEN, the Financial Crimes Enforcement Network, which operates under the Treasury Department and sets the compliance rules that every bank in the United States must follow. A bank must file a SAR if it suspects a transaction is designed to evade federal reporting requirements, or if the transaction has no clear lawful purpose given everything the bank knows about that customer's account history. Let me read that standard to you one more time because it is the most important sentence in this entire video. The bank must file if it suspects the transaction is designed to evade reporting, or if the transaction has no clear lawful purpose, not if the money is illegal, not if you committed a crime, if the behavior pattern looks to an algorithm like an attempt to stay under the radar. This behavior has a name in federal law. It is called structuring. And here's the thing that catches people off guard. Structuring is illegal under the Bank Secrecy Act, regardless of whether a single dollar you moved is from a legitimate source. The law, written at Title 31 of the United States Code, Section 5324, specifically prohibits conducting currency transactions in a way calculated to evade reporting requirements. The intent to evade is what the law targets, and intent for an automated bank system is inferred from pattern. Now think about what that means for someone who spent 40 years being careful. Many people absorbed, somewhere along the way, that keeping deposits and withdrawals under $10,000 was the financially prudent thing to do. Some heard it from a financial advisor. Some read it somewhere. Some just intuited it from the culture around money. Stay under the limit, stay off the radar, stay safe. And so they make withdrawals of $8,500. They deposit $9,200. They rotate between $8,200 and $7,600. Every amount feels responsible. Every amount feels safe. But the bank's algorithm does not see a careful saver. It sees 3 deposits of similar amounts below the reporting threshold over a 60-day period. It sees a pattern. And that pattern matches exactly what structuring looks like in the system's training data. The Bank Policy Institute, which represents large banks and has studied SAR filing patterns in depth, published analysis showing that between 90 and 95% of the individuals whose accounts trigger a SAR filing are ultimately innocent. Only about 4% of SAR filings result in any law enforcement follow-up at all. The vast majority of reports go into a federal database and just sit there. But here's what that statistic does not tell you. Being in that database is not nothing. You do not get notified. You do not get a phone call. Federal law actually prohibits your bank from telling you a SAR was filed. You go into a searchable federal database maintained by FinCEN and you stay there and you never know. And down the road, if you are ever involved in any transaction that draws scrutiny, an estate settlement, a large insurance payout, a sale of property, that prior flag in the database becomes part of the picture. The deeper issue here is that the system was built to catch organized crime. It was then automated at a scale that nobody anticipated, and the automation does not make the distinction between a retiree managing household cash and a money laundering operation keeping deposits below the reporting threshold. Both behaviors look identical to the algorithm. The law asks for reasonable suspicion. The algorithm applies pattern matching. Those are not the same thing, and that gap is where ordinary people get caught. What you need to carry out of this first section is one principle. The IRS and FinCEN have moved from policing the size of a transaction to policing the behavior surrounding it. That shift happened without a press release. Most people still do not know. Now let me tell you about a woman named Diane, because her story is the clearest illustration of what this rule looks like in a real person's life. Diane was 68 years old. She had been widowed 22 months before these events. Her husband had handled their banking for most of their marriage, the checking account, the transfers, the deposit slips. After he passed, Diane had to take all of that over herself, and she was determined to be careful. She stayed at the same community bank they had used for over 2 decades. She knew the tellers by name. After adjusting to life on her own, Diane settled into a routine. She withdrew cash weekly for household expenses, groceries, her lawn service, a part-time home aide who preferred cash payment. The amounts varied but generally landed between $7,000 and $9,000 per withdrawal. She also began giving modest amounts of cash to her 2 adult children every couple of months, usually somewhere between $3,000 and $5,000, just to help them out. She had always been generous with her family. That did not change. Within 8 months of this new routine, her bank's compliance algorithm flagged her account. ASAR was filed. Diane was never informed. She continued banking exactly as she had been. What tripped the system was not the amounts. It was 3 things working together: the regularity of the withdrawal amounts, which fell below the reporting threshold consistently, the lack of any documented business purpose attached to the transactions, and the change from her prior account history, which showed a very different pattern before her husband's death. To a human being, all of that makes complete sense. To an algorithm, it looks like structuring. The system flagged the change in behavior, compared it to known evasion patterns, and filed. Diane's situation has been mirrored, according to compliance attorneys who handle these cases, by thousands of widows and widowers who take over household banking after a spouse passes and inadvertently create a flagged pattern with their new routines. The common thread is not criminal behavior. It is a sudden shift in account activity with no supporting documentation. Here's what I want you to understand about Diane's case. Beyond the injustice of it, it was preventable, not by banking differently, not by moving her account. It was preventable by documentation. Banks, when they investigate a SAR trigger, are required to evaluate whether there is a reasonable explanation for the transaction pattern given everything they know about the customer. Written context, a memo line that says home care expense, or a brief note in the bank system linking the withdrawal to a purpose, changes how that investigation resolves. A human compliance officer reviewing a flagged account looks for exactly that kind of context. The algorithm does not provide it. You have to. We are going to come back to exactly how to create that documentation. First, though, I need to walk you through the second rule, because this one lands hardest on retirees who are accepting help from their families. You are still watching. That says something about the kind of person you are. You are the kind of person who takes this seriously enough to get the full picture before acting on it. That is exactly the right instinct here, because the next rule catches people precisely when they think they are doing everything right. The second rule involves the payment apps that are now part of nearly every American family's financial life. Venmo, PayPal, Cash App, Zelle. If you have adult children or grandchildren who send you money through any of these platforms, and if you have ever used one of these platforms to receive any payment that could look like income, this rule applies to you directly. Let me give you the legal framework first, because the details matter here. The IRS requires payment platforms to issue a Form 1199-K, officially called a Payment Card and Third-Party Network Transactions Report, when their customers receive payments that meet a certain threshold. As of the 2025 tax year and permanently going forward under the One Big Beautiful Bill Act signed into law on July 4, 2025, the federal threshold is more than $20,000 and more than 200 separate goods and services transactions in a single calendar year. Both conditions must be true. And personal transfers, money sent as gifts, reimbursements, family support, are explicitly excluded from this count under IRS guidance. That sounds protective. And for people who understand the system, it is. The trap is in the tagging. Every time money moves through Venmo or PayPal, the sender has to indicate whether the payment is personal or for goods and services. A personal tag means the transaction is exempt. A goods and services tag means it goes into the reporting pool. And many people, including well-meaning children sending their parents money, do not think about this at all. They hit send. The default on some platforms defaults toward goods and services for anything above certain amounts, and the recipient has no control over how the sender tagged the payment. Now layer on top of that the IRS's Automated Underreporter program. This is the matching system the IRS runs after every tax season, comparing what you reported on your return against everything third parties reported about you, your bank, your broker, your employer, and yes, your payment platforms. When there is a mismatch, the system generates a CP2000 notice automatically, without a human being reviewing the specific facts of your situation first. Let me tell you about Patricia to make this concrete. Patricia is 71 years old. She lives on Social Security, about $19,000 a year, and a small pension from a job she retired from 11 years ago. Her total annual income is modest, and her taxes are straightforward. Her daughter, who lives in another state, uses Venmo regularly to send her money. Some months it is $200 to help with a car payment. Some months it is more. Over the course of one particular tax year, those transfers added up to just under $6,000. Patricia's daughter did not think carefully about how she was tagging those payments. A few were marked correctly as personal. Several were tagged as goods and services, either by mistake or because the platform defaulted that way for amounts above a certain size. Patricia never received a Form 1199-K from Venmo because the total amount was well below the $20,000 federal threshold, but the transaction data existed. And one of the states where Patricia did business had its own lower reporting threshold. Patricia received a CP2000 notice in the mail. The letter told her there was a proposed change to her tax return. It showed income the IRS had information about that she had not reported. It proposed additional tax. It proposed an accuracy-related penalty of 20% of the underpaid amount. It proposed interest calculated from the original filing deadline of her return. It gave her 30 days to respond. Patricia had no idea what had happened. She had not sold anything. She had not run a business. She had received money from her daughter, and now she was looking at a federal notice proposing penalties on what was by law a non-taxable family gift. Her situation was fixable. The IRS's own guidance says explicitly that money received from friends and family as a gift or repayment for personal expenses is not taxable income and should not appear on a Form 1199-K. She could have disputed the notice, submitted documentation showing the transfers were personal family gifts, and had the proposed amount zeroed out. But she needed to know to do that. She needed to respond within 30 days. She needed documentation. And she needed to understand that the system had flagged her not because she did anything wrong, but because the tag on her daughter's Venmo payment said the wrong thing. What I want you to take from Patricia's case is this. The IRS system is not looking at the substance of a transaction. It is looking at what was reported. If a platform reports it as income, the IRS system treats it as income until you provide documentation that says otherwise. The burden of proof when a CP2000 arrives is on you. This is the piece that nobody tells retirees. The system is automated. Automated means fast, scalable, and blind to context. Your job is to put the context into the transaction before it ever reaches the system, which brings me to the third rule and the most actionable thing in this entire video. The third rule is about what I call the invisible line that exists on every financial transaction you will ever make, the description field. Every bank transfer has one. Every personal check has a memo line at the bottom. Every Venmo, PayPal, and Cash App transaction has a note field and a personal versus business toggle. And for the vast majority of people, including most retirees, those fields left blank every single time. That blank is costing people. Here is why the description field matters at the federal compliance level. Both the bank's SAR investigation process and the IRS's Automated Underreporter matching system are designed to evaluate whether a transaction has a clear, lawful, documented purpose. A transaction with no description is classified as ambiguous. An ambiguous transaction, in the context of a pattern the algorithm has already flagged, is elevated risk. A transaction with an accurate, specific, appropriate description gives the system something to classify, and classification as a family gift, a personal reimbursement, or a household expense is classification as non-suspicious. Let me walk you through exactly what that looks like in practice. If your adult child sends you money on Venmo, there are two things that need to happen. First, they need to make sure the payment is tagged as personal, not goods and services. That single toggle determines whether the transaction counts toward the 1199K reporting threshold. Second, they should add a note, something accurate and specific. Birthday gift, monthly family support, repayment for grocery run, 3 to 5 words that describe what the money actually is. The IRS's own 1199K guidance, published directly on irs.gov, cites birthday and holiday gifts by name as examples of non-taxable personal transfers. Using that language in the note is not a workaround. It is documentation of the accurate classification of what the payment is. For your own bank transfers, the logic is identical. If you make a regular transfer to your adult daughter for household support, write that in the description field. Household support transfer, daughter. If you are moving money between accounts for a medical expense, write it. Medical expense transfer, dental procedure. If you are making a cash withdrawal for your home care aid, write it in your own records, even if you cannot write it in a bank field. Home care, weekly, name a provider. The annual gift tax exclusion for 2026 is $19,000 per recipient. That means any one person can receive up to $19,000 from you in a single calendar year with no federal gift tax owed, no Form 709 required, and no reporting requirement on the recipient's end. If you are married, you and your spouse can together give $38,000 to each recipient, 2 children, 2 grandchildren, however many people, without triggering any federal gift tax obligation. These are not complicated rules, they are generous rules, but they require that the transfer be clearly identified as a gift, not as income, not as a payment for services. The memo line is how you make that identification. It is the documentation layer that lives with the transaction from the moment it happens. It is what a bank compliance officer reads when they review a flagged account. It is what you point to when you respond to a CP 2000 notice. And it takes 30 seconds. Here is something I have noticed across the cases that compliance professionals describe most frequently. The people who end up fighting these notices almost never did anything illegal. What they share is the absence of records at the point of transaction. The documentation was always theoretically available, bank statements, family texts, their own knowledge of the purpose of the money. But none of it was attached to the transaction itself. By the time a notice arrives, you are reconstructing a record instead of presenting one. That reconstruction is harder, slower, and sometimes not enough. Build the record as you go. The 30 seconds of effort at the time of the transaction is worth hours, sometimes months, of effort later. Now I want to give you the concrete action steps, 5 of them, written out clearly so you can start this week. Step 1. Pull your bank statements for the last 90 days. Go through them and look specifically at cash withdrawals and deposits between $5,000 and $9,999. If you see 3 or more transactions of similar amounts in a 60 to 90-day window, that is a pattern the automated systems are trained to recognize as potential structuring. You have not done anything wrong, but going forward, add descriptive notes to those transaction types, in the bank's description field, in your own log, wherever you can. And where possible, let the amounts reflect the actual cost of what you are paying for, rather than rounded numbers that feel like threshold avoidance. Step 2. Call the family member who sends you money through a payment app. Have a direct, simple conversation. Tell them to toggle every transfer to you as personal and to write a note describing what the money is. Ask them to do this every time going forward. This single change eliminates the most common source of erroneous 1199K data and puts you in the protected category under IRS guidance. Step 3. Start a transaction log. It does not have to be elaborate. A small notebook, a note on your phone, a simple spreadsheet. Every time you send or receive money through a payment app, through a bank transfer, or in cash above a few $100s, write down 4 things: the date, the amount, who it was with, and the purpose. This log becomes your primary evidence if you ever receive a federal notice. Having it prepared in advance is vastly better than reconstructing it under a 30-day deadline. Step 4. Once a year, request your wage and income transcript from the IRS. You can do this through your online account at irs.gov or by calling the IRS at 1-800-8291-040. This transcript shows every form that has been filed under your Social Security number, every W-2, every 1199, every K-1. Reviewing it once a year tells you exactly what the IRS's automated system is going to see when it runs its matching program. If there is a mismatch between that transcript and what you filed, you can often address it proactively before a CP 2000 is generated. Step 5. If a CP 2000 notice arrives, do not panic and do not ignore it. The CP 2000 is not a bill. It is a proposed adjustment. You have 30 days from the date printed on the notice to respond, not from the date you receive it, so open it immediately. Read through the notice and compare the specific line it is flagging to your own records. If the IRS is proposing tax on money that was a family gift or personal transfer, your response is documentation. A note from the family member confirming the gift, proof of the personal nature of the transaction, a corrected form from the payment platform if the original was miscoded. Many CP 2000 notices are resolved at $0 owed once the documentation is submitted, but you have to respond. A notice you ignore becomes an automatic assessment, and an automatic assessment becomes a debt that accrues interest and penalties until it is paid. Here is where I land on everything we covered today. The systems that govern your checking account were designed with a legitimate purpose. Money laundering is real. Tax evasion costs billions of dollars that the rest of us make up for. The intent behind the Bank Secrecy Act, behind the SAR filing requirements, behind the Automated Underreporter program. None of it was aimed at the retiree managing household cash or the grandmother receiving birthday money from her kids through Venmo. But intention does not determine impact. The automation that makes these systems scalable also makes them indiscriminate. And the rules around notification. You cannot be told a SAR was filed. You get 30 days to fight a computer-generated notice. Those rules were written for a world where the system mostly caught criminals. In a world where the system flags innocent people between 90 and 95% of the time, the same rules feel very different. The most practical thing I can leave you with is this. The system is not going to change how it treats you, but you can change how you appear to the system. Documentation is not a loophole. It is not a trick. It is the mechanism the law itself provides to distinguish your transactions from the ones these systems were built to catch. Use it. Start this week. The question I want to leave open, because I think it is a genuinely important one and I want to hear where you stand on it, is this. Should a taxpayer have the legal right to know when a suspicious activity report has been filed on their account? Right now, you have no right to that information. The bank cannot tell you. The IRS does not have to tell you, and yet the data shows that most of the people in that database did nothing wrong. Is the confidentiality justification strong enough to override a person's right to know they are under federal scrutiny? Leave me your answer in the comments. I read them. If you want the full documentation checklist, the exact memo line language that passes the IRS's own classification criteria for non-taxable gifts, written out for every scenario we covered today, it is in the Senior Exemption Playbook, pinned in the comments below, free to download. And if this gave you something real that you did not have when you hit play, do one thing before you close this: subscribe. We track exactly these kinds of quiet regulatory changes, the ones that reach retirees only after they have already cost someone else. You will not get them anywhere else, and you will not get them after the fact.